Hello and welcome to episode 397 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leakes. Damien, welcome back. How are we doing?
I'm good, Andy. Well, we can talk about the podcast meetup now, can't we? We couldn't last week because we recorded early. Now this week we can talk about the meetup, which was great to do. I mean, I think the gods were trying to scupper the whole event for us, wasn't it? The weather turned and got extremely cold. But not only that, on the night that we did it, we'd even been up to the pub in the day before, in fact. Harvey and Justin independently had visited that pub just to make sure it was still open. And on the night, we went to walk in the doors and there was a notice on the front door stating that they had to close due to emergency repairs. So I don't know what that was, but of course that caused a massive problem for people who came to the event. We had to go to Leadenhall Market, so we had to change venue at short notice. So we put it out on our socials to people that we had to go across to Leadenhall Market. It was freezing. We were outside a pub. We did eventually go inside a pub. And thank you to those people who did persevere to find us. I know there were many people who went to the original venue and then were confused as to what was going on because the lights were on in the place and the doors were still locked. Apologies, but that was out of our control. But those of you who did persevere and came and met us, we're really grateful that you did, and we had a good evening. And one of the things that came out of the conversations we had that night is that we are looking for new moderators on our Facebook group. So somebody said that on the Facebook group, there'd been a couple of spammy type posts in the group, which we obviously endeavour to make sure they are removed. So we have some moderators within Money to the Masses, but also one or two external people as well who are part of the group. Obviously, we are looking for more people who can help us to run it. They will approve the people who can join. They will flag the comments that are spam or inappropriate, because that does happen even though we try to stop it, and they can then actually remove those comments as well. So if anybody wants to be part of the moderation group, then just send an email to Andy at moneytothemasses.com. We've already got one person who I met at the event who is going to do it. We're going to enact that next week for them. So if you'd like to be part of it so we can make sure the community is what you want, then send Andy an email. For those of you who've not yet joined, go to facebook.com/groups/money to the masses where you can, of course, join. So that was a podcast meetup. One thing I want to say before we get on to what's on this show this week, Andy, I do plan to do a piece on capital gains tax in the new year, because obviously the capital gains tax allowance was reduced in the recent autumn statement. So there are capital gains tax planning that needs to take place for some people. So somebody asked me, could I do a podcast on what they should do and what to look out for? So I will do that in the new year when everybody's head is back in the game and they're doing their admin, which is probably better that side of Christmas rather than this side of Christmas.
Okay, so let's move on to what's coming up on the podcast this week. I'll be doing a short piece at the end of the podcast, and it's to do with a particular type of fraud, loan fee fraud. And the FCA has made an announcement recently to try and highlight what it is and what people can do to avoid becoming a victim. And Damien, what's the two pieces you're going to be covering?
I'm going to be covering an investment piece. Again, it's inspired from a piece of 80/20 investor research that I carried out this week, which ultimately highlights one issue with passive investment funds. So I want to talk about that. The other thing I'm going to do is do a bit of a recap on where we are with mortgages. So I know we've talked about mortgages since the mini budget on one or two occasions, but it's the one thing I'm asked about all the time in the money world. So people always want to know what's going on with the mortgage market. And the thing is, things have changed quite quickly. So where we were 2 months ago, or even 1 month ago, is quite different to where we are now going into 2023. So I want to do something on that, just so people are aware when they're planning, particularly if they're one of the millions of households that are going to be remortgaging in 2023 or 2024.
Okay, so let's make a start then. The investment piece, what have you got?
So 2022 has been a difficult year for investors, and that's principally because bonds and equity markets generally have fallen pretty heavily. And that is obviously partly because of the Ukraine war, but there are the issues of rising inflation and central banks hiking interest rates. And that's had a big impact on various asset classes. And we've seen bonds and equities pretty much fall in tandem throughout the year. Yes, we've had rallies, but generally speaking, we've been on a downward trajectory. So given that backdrop, I looked at the idea of active versus passive funds. So active funds, for those of you who don't know, are funds that are managed by a human. So a man or woman fund manager that has a mandate, which they then supposedly use their skill and research to pick the investments that fund might invest in. So if it's a UK equity fund, they might pick particular shares that are of companies in the UK to invest in. And the aim is therefore to outperform all their peers, all the other fund managers, and also they would want to outperform things like passive benchmarks like the FTSE 100, for example. If you look at the mandates on any fact sheet, they often refer to things like the FTSE All Share Index. Now, the flip side of that are passive funds, and they're just funds that are run by automation, effectively. They're run by machines, but what they will do is they will track an index or indices, and so there isn't as much human intervention in that. They will just track an index. Let's pick the S&P 500 in America, for example. So a fund might track that. Now, over the long run, there's been lots of different bits of research that have been conducted that show that fund managers don't tend to outperform passives over the longer term. And of course, you can pick some of those apart. And I've always been of the mindset you invest in what's working. I don't look at funds and say, is it passive? Is it active? I look at what's working and make decisions based upon research. Now, this year, 2022, you might think that given that we're in a downward year and given that a passive fund will be tracking an index, so let's say it's tracking one of the major equity market indices, whether it's the FTSE 100 or the S&P 500 in America, then they will just keep following it into oblivion as it starts to tumble. You might hope that a fund manager that may be invested in UK equities, or in the case of comparing to the S&P 500 in US equities, might start to apply the brakes or do something a bit different. They might pick alternative shares or whatever, and they might use their skill to try and preserve capital. So what I did is I looked at the emerging market equities as an asset class, European equities, global equities, Japanese equities, North American equities, and UK equities. And then finally, I looked at some bond markets, so sterling corporate bonds, UK gilts, and UK index linked gilts. And that was a lot of fun. So it was about 1,300, and I had to separate them into passive and active funds and then look at their performance throughout 2022 to see if in a year where markets are tumbling, whether active funds outperformed or passive funds outperformed in that year. Now, before I talk about the results of that research, I want to go and give you some insights to two previous bits of research that I carried out in the last 5 years for 80/20 investor members. And I can't recall if I have done it on the podcast. I didn't have time to go back and look at past episodes. But one of the pieces I did was to look at whether active funds outperform passive strategies in sideways or falling markets. And so what I mean by that is a market where it's largely range bound. So you get rallies and dips, but really the market, if you look at it, has gone really nowhere for a period of time, could be months or even longer. Or I wanted to see if in falling markets like we had in 2022, whether active or passive strategies outperformed. So that was a sample size back then of a set period. And it was a bit inconclusive, to be honest. And I will probably revisit it because we've had some great examples of extreme moves in markets. So the pandemic is a good one. With 2022 is another good example where you can get insights by analysing what markets did. But what I found is that there was a suggestion that fund managers, so active funds, might outperform in a market, so a rising market that has followed a sideways market. And that does, if you think about it logically, make some sense, because in a sideways market, you will probably get active fund managers trying to make a bit of extra return by taking on a bit more risk. And therefore, if the market then explodes higher, they've loaded up on that risk. So they may have invested in more volatile shares, or they might, if they were a multi-asset fund, might invested more in equities, for example. And then when the market exploded higher, then they've obviously benefited from that. Of course, the converse could be logically true as well. So that was something that to bear in mind when you look at what's been going on in 2022, because we've basically been on a downward slump all the way. Now, the other thing is I looked at a piece of research where I considered whether there were sectors where active funds beat passives more readily. So rather than just looking at them as a big group, break them down into different sectors, so different asset types, a bit like I mentioned at the start of this piece. So what I found when I did that is I looked at not just whether they'd outperformed, but the consistency of any outperformance or underperformance. And largely speaking, North American equity funds, actives tend to underperform passive benchmarks like the S&P 500, so therefore they underperform any passive funds based upon that index. While in Europe and the UK, they tended to consistently outperform passive peers. So that was an interesting finding. I'm not going to go into all the details of that piece of research, but take those into your mind. So you might think that in 2022, based upon those, it was going to be dreadful for active funds, but we might still see the UK equity space outperform their passive peers. And so we would probably expect to see active North American funds underperform their passive peers, because that is pretty much what we've always seen in recent history. Well, what we found is when I looked at 2022, under each group, so the different asset classes I mentioned, the only ones where active outperformed the passive strategies were North American equities, so that was a slight surprise, and two bond sectors, so the sterling corporate bond and UK index-linked gilts. So all of these sectors were down. The only place where we didn't have a negative return was actually the passive strategies in UK equities. So that was interesting because it went against some of the previous research and conventional wisdoms. So I started to look at, well, why is that? What's been going on there? And digging into the numbers, there is something that starts to become apparent, and it's to do with the way indices are often structured. So first of all, let me look at that UK index-linked gilt return. So yeah, active funds were down 29% year to date. And when I say year to date, all these numbers were done up to the 10th of December because we've not got to the end of the year, obviously. Whereas passive UK index-linked gilt strategies were down 32%. So they're down heavily. They were one of the worst performing assets year to date, but there is a marginal difference. Pondering that, why would that be? And one insight, if you go back to episode 365 of this podcast, where I talked about index-linked gilts and the flaws in them, because people were wondering why weren't they doing well in this environment, given that inflation was going up. And one of the issues is duration. And I explained about duration, and it's to do with interest rate risk. And so if you want a full explanation, go back to that podcast. But in a nutshell, what happens is that the index-linked gilt funds are very, 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 very sensitive to interest rate moves. So what we got in this year, lots of interest rate moves or expectations of interest rate moves. So we've seen them perform badly. But if they are tracking an index of index-linked gilts, so I'm talking about passives here, then they're going to basically get the full brunt of that downward pressure. And index-linked gilts are more sensitive to interest rate moves than normal UK gilts. So they are a particularly sensitive asset class in that regard. So that might hint that maybe the active managers were able to reduce their interest rate risk on their funds. You do that by reducing duration. So I'm not going to go into how that works, but effectively they've made tweaks so they weren't as effective. That's a potential explanation. Now, this whole thing about interest rate risk then starts to perhaps explain something that we saw with the North American equity. So as I mentioned, I'd have expected them to perhaps underperform. They always have done. But what we saw is that North American active funds marginally outperformed passive strategies. And it was only marginally. I'm talking about this as an average group. I'm not digging down into individuals because individually, which I'll come back onto later, there are some interesting things that occurred. But as a group, active funds marginally outperformed passives. And then when I looked upon it and considered what was going on, something started to again stand out, and it kind of links to what was going on in the index-linked area. So the S&P 500, for example, which is an index which a lot of passive strategies might be based upon, but that is a cap-weighted index. And what that means is the 500 companies that might be in it, they're not in it equally. Their exposure in that index is based upon their size, so the total size of their shares out there, so their market cap. to give you an indication, if we take Apple, Microsoft, Amazon, Tesla, and Alphabet, which is Google, they make up almost 24% of the S&P 500. That's nearly a quarter. So nearly a quarter of what goes on, whether it's good or bad on the S&P 500, pretty much depends upon those shares. And of course, that means that in a year where tech companies have been hammered, and they've been hammered because as interest rates rise, then it starts to impact technology stocks in particular. And that's because technology stocks have the ultimate payday so that the earnings can be way off in the future. So when you discount those earnings back, the higher the interest rate, the smaller that number is when you discount it from the future. So again, you don't have to understand that, but what it means, that makes a lower share price. So if you had a pot of money and you discount it from the future, then the higher the interest rate, the lower today's sum. If you want to think of it in the reverse to help you understand it, the higher an interest rate you have, the smaller pot of money you have to put into a savings account to get a number way off in the future. So it works in reverse. All you need to know is when interest rates are going up, or the expectation of them are, technology stocks tend to get hammered. Just go and look at what happened on the stock market this week when the expectation of what the Federal Reserve would do in terms of future interest rate hikes, that went up. So you look at the tech stocks this week, they got hammered, and so the S&P 500 has struggled. That just shows you it in the real world as a bit of an example. Now, that shows that what we've got here is a problem with passive strategies, or not a problem, something you need to be aware of. If I looked at the equal weighted S&P 500, so rather than market cap, I just allowed it to be equally weighted. Every share had the same percentage exposure in it. Then rather than the S&P 500 being down 17.5% this year, it'd only be down just over 11.5%. That's a huge difference. So this therefore highlights an issue with passive investment strategies that people might think you buy and forget, but what you're actually doing is, if a passive strategy is based upon an index or collection of indices that are market cap weighted, then you have a significant exposure to whatever the biggest holdings are. And in the case of the S&P 500, it's some of these big tech stocks. And of course, when you get a macro backdrop like we've got now, which hammers them, then that makes them underperform. And that's part of the reason why you see a lot of these passive strategies struggling this year. So taking that thought and looking at what happened in the UK, the active funds in the UK underperformed their passive peers. So I'm talking about 2022 here. Active funds were on average down 9.4%. Passive funds were up 0.5%. That is a big swing. And now, again, the FTSE 100 is a cap-weighted index. It's another example of one. And if you look at the largest constituents within that, well, Shell PLC is nearly 10% of it. AstraZeneca, so that's the drug manufacturer, they are 8%. BP is 4.75%. So all three of those stocks were up over 35% in 2022 because of the rally we saw in oil prices as a result of what's been going on in Ukraine. And of course, because of their overweight, that has a big impact on something like the FTSE 100. And so if active funds are picking a benchmark that is cap weighted, it can mean that they will outperform when the macro backdrop changes in their favour, as it has for US equities in 2022 with tech stocks being hammered. So the point is, active fund managers will look at their universe, which could be UK equities or US equities, and they've got this whole wide range of companies to pick, and they'll go and choose them, but they aren't restricted by market cap. And so what it means, when we compare them over time, US active managers underperformed the S&P 500 because of that cap weighting to technology stocks. And technology stocks, as we all know, have been the real winners prior to 2022 for about a decade. And so we have to bear that in mind. The lesson of this piece of research is there's no point talking about active versus passive. It doesn't really make sense. It's what is working at that time. If you look at the top three performers from each of those different asset classes I mentioned, only two of them were passive funds, and they were in the UK equity space. All the other top performers were active funds. And that's because of the macro backdrop, which is probably the biggest determining factor of whether passives outperform active funds in any given environment. And the other lesson is that if you have passive funds, why not have a look to see if the benchmarks that they might be tracking, if they are tracking benchmarks, if they're cap weighted, and then drill down to see what do you overexpose to, or what you overweight or underweight, just so you understand how your portfolio moves. And you could therefore decide to pick a different passive strategy that might, for example, track an equally weighted version of an index like the S&P 500. So there's a lesson there that once you start digging into numbers, something fascinating can come out the other side. But then moving forward, that could be interesting for 2023, because if this environment continues, you drill down, then it could be positive for active fund managers if this backdrop carries on. And that is in certain, obviously, areas, like I said, for active managers in the US. For active managers in the UK, they've not done so well. But of course, it could also see what happens if markets maybe go sideways for a period of time and then explode higher. Maybe that could be positive for them. But the message is, look at individual funds, don't care whether they're active or passive. And as I mentioned, there's some interesting things here. I'm not going to read out the top performers of 2022, but they are largely active funds in this particular case. And a number of them I do hold in my 50k portfolio I run on 80/20 Investor. And that's because the way the research works, it just looks for what is working and doesn't really make a judgment on that. And that has helped me this year.
So we've had another base rate rise by the Bank of England this week, increasing it from 3% to 3.5%. And Damien, you're going to give some insight into what is happening with mortgage rates heading into 2023.
Yeah, so this week we know that the Bank of England base rate went up again as expected to 3.5%. I'm not going to dwell on that. We've done articles on the Money to Masses website, which you can find if you're a member of the newsletter that goes out every Sunday. You can sign up if you're not, moneytothemasses.com/newsletter. The articles are all included in there, but broadly speaking, for every 0.5% increase in that base rate, then your mortgage will go up by £25 for every £100,000 that you've borrowed over a 25-year period. It's a good benchmark anyway. And so looking at all the past 9 hikes, because it's been 9 now in a row since December last year, then we're talking about all those hikes that have been added up. That has added £177 per £100,000 borrowed on a mortgage. So that for somebody who is yet to come off their fixed rate deal in that period, you can do the numbers to work out what your mortgage could go up by based purely on where the rate is today. And what I wanted to do, because the market has been in turmoil, the mortgage market has been all over the place, and we've done some bits and pieces in recent months on it, and it's partly because of that mini budget. But the reason I wanted to talk about it today, because as we head into Christmas, I know there'll be a lot of people worrying about their mortgage, what's going to happen to it next year, and there'll be people who hopefully will be putting money aside, trying to be a bit careful, and I want to give them an update, because the newspapers can be quite sensationalist about things, but I want to dig beneath that surface. So after the mini budget, which happened on the 23rd of September, there was a race to fix mortgages. And that's because mortgage rates went through the roof, because effectively the gilt market exploded. So yields went higher. Mortgage pricing went through the roof as a result, because swap rates went up. We don't have to understand what they are, but just put it this way, market predictions of where interest rates would go went higher because they thought inflation was going to keep going higher. And it wasn't until we had U-turns and sackings and also the Bank of England intervening in the gilt market that things started to calm down. So to give you an idea of where we were until where we are now, back on the 27th of September, so this was days after that mini budget, the prediction by the market of where the base rate would be in September 2023, so that was a year after that, was 6.39%. So that was a huge jump. And of course, that's why the mortgage market then exploded higher, because all those fixed rate deals went up above that level. But they also predicted in 4 years that the interest rate, or the Bank of England base rate, would still be at 4.1%. So that was obviously a significant increase. Don't forget that in December, or before December, I should say, last year, the base rate was only 0.1%. So that was a huge jump. Now, as the things have moved on, the mortgage market has thawed a little bit. We've seen rates start to come down, because the problem is the rush of people wanting to fix obviously drove up demand. The providers were uncertain about what to price their mortgages at in terms of where the base rate and things like that would be in the future, and because of the financing that they could actually get. So the rates weren't really coming down at all. And of course, don't forget there's that first mover thing that happened. So if somebody were to cut their rates, and they would get a flood of business, and they wouldn't be able to actually deliver upon that when the actual customer service was called upon. But moving towards 19th of October 2022, by that point, the market was predicting that the base rate would get to 5.66% by September 2023. So that was already a fair drop. It wasn't a 1% difference, but it was heading that way. But what was interesting is that they actually started to predict that the base rate in 5 years' time would be 4.6%. So you can see there's a bit of a seesawing going there. They were predicting that rates won't be as high next year, but they were predicting they were going to be higher than they previously thought in 5 years' time. So just so people know, for reference to why I picked those dates, the peak of where rates would be predicted to be next year, this is the base rate, was 6.39%. And the peak that we've had for 5 years' time was 4.6%. So that gives you some figures in your head when you're thinking about fixed rate mortgages, where they were being priced. Because don't forget, there's always going to be a certain percentage above those numbers when you actually buy a mortgage product. Now, where are we? Well, at the moment, as I make this podcast, the market is predicting the base rate is going to hit 4.6% at the peak in July. So that is significantly lower than the 6.39 I mentioned earlier. And they are now pricing that in 5 years' time, the base rate will be 3.13%. So that's dropped by more than 1% from what they were pricing back in October. So what you can see is the market is now thinking the base rate won't be able to go as high, or won't go as high. And while they will stay higher for longer, but it won't be as high as they had previously been pricing in September and October this year, when the real panic set in. And what's interesting is that where we had mortgage rates in October, a 2-year fix was at 6.65% on average, and a 5-year fixed rate mortgage on average was 6.51%. To compare that 6.65 2-year fix would have been 2.34% a year ago. So that was enormous difference. So that's why everyone's been panicking, and that's why it's been sensible to put money aside and you speak to a mortgage broker if you were coming to the end of your mortgage within 6 months. Where we are now, if you've got a 60% loan to value and a loan over 25 years, I'm using some broad assumptions here, a 2-year fix is now 4.85%. This is the best, not the average, the best. The best 5-year fix has now come in and dropped down to 4.5%. So that's much better. So that dip in long-term expectations of where interest rates are going to be are starting to feed through. And of course, in the market now, when you're looking at that, the cheapest tracker we've got is round about 3.5%. If I look today, it's about 3.2, 3.3, but it hasn't taken into account the base rate hike that happened yesterday. So we're looking probably between 3.5, 3.6. So you can see that those numbers are coming towards each other. So you get a 2-year tracker probably about 3.5%, whereas you're getting a 2-year fix at about 4.85 now. So they are starting to come in together. Those differentials, as I've mentioned in recent podcasts, trackers and discounted mortgages, so these discounted variable rate mortgages, are starting to become much more attractive to people because they are lower initially. Of course, if rates go up, then they will go up, whereas a fixed rate mortgage won't do. So what we've seen, just to give people insight into what's going on out there when people are talking to brokers, depends who you talk to, but anecdotally, the number of people 2 months ago, when things were at their worst, 90% of people were getting fixed rate mortgages. In fact, even before that, the vast majority of people would get a fixed rate mortgage when they went and got mortgage advice. That's dropped down to, depending on who you're talking to, only about 50 to 75% of people are now getting it. People are now starting to look at variable and discounted products and trackers. So that is partly because they're cheaper, but also because they're starting to try and play the interest rate game. So they're trying to sit there and think, well, if rates go up, but then they come back down and I can remortgage, and maybe I don't want to fix for 5 years because I could fix at 5-6% and then I'll be stuck on that. So that is starting to happen. So just throwing it out there to people who are listening, that where we are now with the mortgage market is very different to where we were a month ago or 2 months ago. And again, mortgage brokers have their predictions of where they think things will go, but some of them are starting to think, well, maybe rates will come down on fixed rate products towards 3% in the next 18 months, which would obviously be much better news than what people were faced with just a month or two ago. And of course, going back to what people are often doing now, whether people are taking 2 years or 5 years, it very much depends on your own circumstances, whether you are more worried about keeping your mortgage payments fixed for longer and what you can afford. But obviously, there are a lot of people favouring short-term fixes because they're thinking they might come off them again. And the other thing I want to just throw out there are some interesting products that are starting to make headlines. So things like tracker products that are switch to fix. So switch to fixed trackers. And what they do is they enable you to be on a tracker rate, but then at any point change it to a fixed rate without having to pay an early repayment charge. So that's quite an interesting product. The point is you need to speak to a mortgage advisor, as I've said in the past many times. It's one of the few times where I think getting advice would really help, because you get the full range of products that will be suitable for you, and they can help you actually find the products you're probably more likely to be accepted on. So the lessons of autumn 2022 are that things can change very quickly, and still be mindful of early repayment charges. But the pressure is seemingly easing. But that doesn't mean that, for example, somebody like me, when I talk about living like it was 2024, like late 2024, do you remember I was talked about that in the past and saying that I was putting money aside, assuming my rates will go up? Just as quickly as things can go from where they were at the beginning of September to really bad in late September, October, and then they're easing, we could go either way again. So you've got to bear that in mind. But I just wanted to say this before Christmas. There'll be people who'll be worrying about their mortgage and what's going on with rates. And unless you look at them and watch them like we do and look at what's going on in the market and seeing on swap rates and doing charts and all these sorts of things, you might not realise that there is a little bit of downward pressure at the moment that is starting to make fixing less attractive than it obviously would have been just before and around that chaos that happened at the mini budget. So again, seek advice, but things may be starting to thaw in the mortgage market.
Okay, and just a reminder for listeners that Damien updates a regular post on the Money to the Masses website, and in fact did a video this week which went out onto YouTube, and it was embedded within the article itself, and it looks at exactly what he's spoken about then, because we can't chat about interest rates on every single podcast every time there's a rate change, because it does date the podcast. So make sure that you go and look at that, bookmark it if you can. We'll put it in the details on the show notes to make it easy for you to find. Okay, so moving on to the final piece of the podcast then, and I'm going to cover something called loan fee fraud. And the reason I'm bringing it to the podcast today is the FCA have created a bit of an awareness campaign to let people know about what it is, how it can impact people, and what they can actually do to make sure that they don't become a victim. Now, the stats that they've produced on this says that 2 in 5 people that are celebrating Christmas this year are feeling pressured by family and friends to maintain their usual Christmas spending this year. And we've talked about that in the podcast in the past and how you can actually avoid that by having an agreement with family and friends that you're not going to buy for adults, that kind of thing. But there are people that are worried about how they're going to afford Christmas, and more than 1 in 8 people have said that they intend to take out a loan in order to support their Christmas spending this year. So with that in mind, I wanted to bring to you loan fee fraud. Now, loan fee fraud is where a purported loan provider will come to you and ask you to pay a fee up front in order to guarantee a loan or credit. And then, of course, because it's a scam, they never receive those funds. So I'm just going to read out a few of the warning signs on this. So if you're someone or you know someone that's made several loan applications online, and obviously what comes with that is you tend to get contacted by quite a lot of the providers to let you know how your application is progressing. Obviously, be careful if you're doing that, first of all, because of your credit rating. You shouldn't really be applying for more than one loan at a time, and only ever apply for a loan that you're pretty sure that you're going to get. But obviously, desperate times calls for desperate measures from some people, and this is sometimes what they have to resort to. Scammers do get hold of your information sometimes and perhaps are aware that you're desperate for money, and so you may be contacted out of the blue either by text, email, or phone and offered a loan. You'll often be asked to make an upfront payment into a bank account or maybe transfer money via an unusual method. So again, that is a warning sign if that happens to you. The scammers will claim that the fee is refundable in an effort for you to make the payment quickly. And they'll often say that it will be used as a deposit or an administration fee or perhaps an insurance product that comes along with the loan. So be aware of these practices. Be aware if you're being put under pressure to pay that fee quickly. And again, if you've made a payment and then you're contacted again for further payments and subsequent payments, your loan still hasn't arrived, that is another cause to be concerned. And so while researching this piece, I found out ways in which we could share on the podcast how to protect yourself. And I was pretty staggered to realise that fully FCA authorised and regulated firms do actually carry out this practice sometimes. And so it isn't as unusual as you think. The things that you can do, however, to make sure that you're not a victim is to do the following. Always check the Financial Services Register to see if the firm that you're being contacted by is regulated by them. They should always be on that register. Check that the firm's contact details match that register, and always use the contact details on the Financial Services Register rather than a direct line or email that's given to you in separate correspondence. If there are no details of that provider on the Financial Services Register, or the firm claims that they're out of date, call the consumer helpline. I'll read that out here. It's 0800 111 6768. What I'll do is I'll put some details on the podcast notes about how loan fee fraud works, what you can do to make sure you're not a victim, but also how you can report a scam if you believe it's happened to you. So just to make listeners aware, coming up to Christmas, this kind of scam does exist. Please don't become a victim, and do report it if you believe that you've been targeted in this scam. So Damien, that's it for this week, isn't it?
Yeah, we are. We're done. So as ever, please do review the podcast. We keep saying to people that we're going to remind people at the start of the podcast to review it, and we never, ever seem to. So we have had some reviews. Please do leave a review. It will make our Christmas. We'll read some out, hopefully, in a future episode and give away some mugs to those people who have actually done it. As ever, like I mentioned earlier, join the Facebook group, facebook.com/groups/money to the masses. So that is it, Andy. Until next time.
Until next time.